Now we've got the latest business news. Very honoured to have business editor Giles Beckford joining us this evening. Giles,
the honour's all mine.
Hey Giles, it seems the Reserve Bank is a good deal less worried about the impact of the coronavirus on the economy.
Yes, I think they've looked beyond the headlines. I describe this as the economic version of them saying, take a couple of paracetamol, take yourself off to bed, keep up the fluids, get lots of rest, and if you're not feeling better in a couple of months, then give me a call. Because essentially they're saying they think that it will be short, it will be possibly sharp for some people, but it won't last, and the effects probably will be felt in different ways by different sectors. Now, we know about tourism, travel, some education sector, some disruption to food exports and that sort of thing, but they don't think that will last. And so, from that point of view, any thoughts of cutting the official cash rate to try and insulate, should we say, inoculate the economy with lower interest rates didn't really seem to come into their thinking. Remembering that it takes a good 9 to 12 months for any interest rate to work its way through the economy anyway. So by the time you actually start to feel the effects, everything has changed since then. So they're still thinking, though, that we will take a short-term hit. They have in their growth forecast for the first 3 months of this year, so that will be the 3 months to the end of March, they've nearly halved their growth forecast by 0.3%. Now, I've done some very rough calculations on the back of an envelope. By my thinking, that's about a hit of just under $1 billion for the economy during that period. So we would have grown more if we hadn't had the virus. Here's the Governor, Adrian Orr.
So we are looking at around, I would say, a 6-week hiatus disruption. You know, the working assumption is that travel bans are lifted and there's some renormalisation over the month of March with some lingering effects. So that is a working assumption. How much would we need to respond? That's going to be a function of what we're responding to. And without doubt, monetary policy would only be part of any response. There is ongoing response already through traditional automatic stabilisers from government transfer payments, IRD efforts. There's a whole of government type of response that can go on. The monetary policy response would be a bit player in that.
So, of course, time will tell whether he's right or not. But I'm guessing it will need a significant global escalation, and this will need to become a global pandemic with real serious worldwide consequences for the global economy before the Reserve Bank starts to contemplate whether it needs to cut rates. And I think from that point of view, it's just it will be roughly business as usual. As Adrian Orr likes to often say, we'll just keep watching, waiting and worrying.
So, OK, no cuts. Generally speaking, then, you touched on it, but the outlook, what are we expecting?
Well, they're reasonably upbeat. Clearly, they feel that the interest rate cuts from last year, and if you remember, they cut by 0.75 of a percentage point in two bites, taking the cash rate down to 1%. They've seen that flow through to the housing market. They're looking at the employment market. They're seeing that that's solid. Of course, one of their jobs from government is to maximise employment. And they say, well, we're doing that, possibly doing it a little bit more. They look at inflation, and of course, they see it now in the sort of Goldilocks zone, which is there or thereabouts their 2% target. So their economic forecasts are reasonably upbeat. They say it will take time. There are going to be a few shocks here and there. For instance, there's a potential for drought in some parts of the country. We'll wait and see on that one as well. But all in all, their forecasts are pointing to growth of around 3% towards the end of the year going into next year. And if that transpires as they think, and of course there's the government stimulus package that's yet to take effect as well, they're thinking that they may start raising interest rates, and we haven't seen that in a year or 5. They may start raising interest rates towards the end of next year going into 2022.
Interesting. Hey, can you just give us a bit of an overview? Sky TV's result today, not, well, as rosy as they would probably like?
Well, no, they took a hit, and we always knew that they would take a hit. Barely made $12 million, I think, or very close to it for their profit for the half year, compared with nearly $60 million last year. The point being that they're a business in transition. They spent close to $300 million buying Neon, the rugby pass business, transforming other bits of their business. The problem for them is that while they're doing this, they're still losing money on their old-fashioned satellite service. The money that they're losing is bigger than the money that they're gaining from the new services, even though they've managed to slow down the number of people who are disconnecting. So from that point of view, Sky TV, it's saving its money, so there's no dividend to be paid to shareholders. There's more to come as they transform themselves more into a streaming-based service and provider of sports and the like. Remembering they've got to pay for those rugby rights because they paid well over the odds for the Sanzar rights for the next few years. They're still battling the likes of Spark Sport and all the other people who are out there. This is a business that I think it won't sprint. It will walk slowly, and at times it will look like it's limping towards the future. But under new leadership, they seem to have at least turned the corner, if nothing else.
So where did the numbers end up at the end of the day?
Our top 50 index up 64 points. That's about 0.5%, 11,900, well, within a smidgen of it. And that's only a couple of hundred points shy of record territory. So for all the nerves and volatility out there, the market's still doing reasonably well. It was, of course, buoyed by the Reserve Bank statement with no rate change. Good for shares. That gave the Kiwi dollar a shot in the arm as well. We gained nearly 0.5% against the US dollar, just touching 64.6 US cents, 96 Australian, and just over 50 British pence.
Thanks, Giles. That's Giles Beckford, our business editor. They let him out late today with our business news update and all the numbers.